Hello, my name is Janesh Patel. I'm from Uptime Health, but before starting Uptime Health, I was an R&D tax credit consultant. And in 2017, I was actually the #2 R&D tax credit consultant for startups in the US. The only person above me was the person who wrote it into law. And I created the most amount of R&D credits for startups in the US in 2017. So I'm gonna give you some ideas as to what you should look out for if you're a startup, which I believe everyone who's watching this video is, why you should either ask the questions to your CPA in terms of if this benefit is right for you, and if you still think it's right for you and they say it's not, come talk to me and we'll figure it out together. So big thing is, oh wow. All right, so the R&D tax credit, just for history purposes, comes from Section 41 of the IRS tax code. So Google it if you have spare time, figure it out for yourself. But what this credit is for is to give money back to people who are doing R&D in the United States. And R&D is a lot more than you think it is. It's not just lab coats and test tubes. It's everything from software development, engineering, architecture, and even concrete mixing. Like we've seen R&D be qualified in every industry in the US, which is why don't count yourself out even if you're not doing software. But what the R&D tax credit says is if a client or a company is doing or committing money to R&D efforts year over year, they deserve a tax benefit back since they're keeping jobs in highly technical jobs in the US. And the things that they look for are wages. So how much are you paying people for doing R&D? So this could be your software developers. I'm going to talk in software company terms. I feel like most of the companies in GSV Labs are software companies. So wages for what you're paying software developers, contractor costs. So if you're paying contractors to do R&D, so if that is a dev house that you're using, there's a potential to take this. I'll tell you why you can and why you can't. Supplies. This is more for maybe people who are doing actual lab-based work, who are making consumables come through their R&D process. There's not really supplies in software, so you wouldn't really see this as a category you would care about. And the last one is called computer rental. This is an interesting one because the R&D tax credit was written in 1981, and back then people rented computers to do R&D. So they were like, take the money you were putting into renting computers as part of your cost. There was a weird period of time where no one was renting computers, so this really wasn't relevant, but now that hosting costs have come back into the world, you're technically renting servers, so you can take your hosting cost for all of the hosting time and money you're spending in your dev environment, but not in your production environment. So that's one thing that no CPA really looks into now because they don't really understand your business, but I do. So these are the big categories that we talk about. And what you want to do is look at your company from a perspective of how much did I pay people who were doing R&D development. So in software terms, our software engineers, we know they come in all shapes and sizes. These are the guys doing the true R&D. So every dollar you're spending on their box 1 W-2 wage, you can take as a qualified research expense to this R&D credit. What you can also do is take what they call a 1 up and 1 down approach. So anyone who's supervising engineers, so this could be scrum masters, could be a QA person, could be your product manager, the amount of time that they're supervising software engineers for their R&D work, you can take that too. And last thing is what they call support. And this could be your testing people. So people who aren't really developing code, but they're running through, giving you feedback, user interviews, whatever that might be. But at the end of the day, everything in here is going right back into software engineering. So these are the categories, if you're a software company, that you would look for wages from. Contractors, once again, if the contractors are doing this work and you're paying them, you can take 65% of the money you spend on them. The only time you can't take contractor work is A, if they're not in the United States, and then B, if you pay them on a fixed fee or lump sum basis. You can only take it if it's a time and material basis. I can go into that in more detail later. Supplies, like I said, not really relevant for software, but if you're consuming supplies in your R&D process, let's say you're a life science company and you have a lot of chemicals going through some process and it's consumed, you can take that. And like last thing is whatever you're spending on hosting for your dev environment, you can take all these costs. Okay, and so there's 2 things of why this R&D credit is really beneficial. One is if you're paying real taxes, the calculation you do with all of these expenses goes against your real taxes, so it's a check back to the company. If you're a startup company, you're not paying taxes, you can actually take it against the payroll portion of your company's expenses that they pay for Social Security for their employees, which is, I think, 6.2% on today's W-2s. And the way you would qualify for the R&D credit if you're a startup is you have to meet these criteria. You have to have made less than $5 million, and if you're in GSV Labs, you might be, but you have to have made less than $5 million in your current tax year. You would have to also have less than 50 employees currently, so sorry, less than 50 employees. And you cannot have made revenue 5 years prior to your current tax filing period, which means you cannot have made revenue in tax year 2013. So if you marked off on one of these criteria, you can't take it against payroll, but you can still take it against your regular taxes and carry it forward like a normal tax credit. And the last thing I'll do is run you through some quick high-level math. Do this equation yourself really quickly, and if you're a small company, meaning you meet this criteria, the rough back in the napkin math is 10% of all of this is the credit. Imagine that. So if you're spending 200 grand on this, which many people probably are, that's $20,000 you can take against your payroll taxes every quarter. So that's basically a quick snapshot of this. Ask your CPA to look into this for you if you're interested. If they say you don't qualify, come to me. They used to hire me out to make sure that their clients actually did not or did qualify, and I will tell you the real truth. And I've met plenty of companies here that actually do qualify that never thought they did. And I actually talked to a company last week whose CPA said that they didn't qualify, but we were able to qualify $200,000 for them. So just know, ask me before you just ignore it all.